Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We are looking at futures that are significantly down, although these numbers, in comparison with the face-ripping rally that was executed yesterday, look like nothing. 2% on S&P futures after the cash trade yesterday produced a gain of 9.5%. I'm pretty sure NASDAQ was up like 12% yesterday, and futures are only down 2.5%. That's a win if you do the math, at least now at the open. Breaking ground, ringing the opening bell at the New York Stock Exchange. I believe that's a charity to try and get homeless people some help and off the streets here in New York. And then you've got a Chinese education company pushing K through 12 education in China, ringing the bell on the NASDAQ. Ruan Yun, I think they just went public. So, Katie, in terms of the real stocks to watch today, and in terms of the action after yesterday's indiscriminate buying, what are you seeing?
Well, we're seeing that there's still plenty of uncertainty out there. We had CarMax report earnings today highlighting that continued uncertainty. Even though we got a little bit of relief yesterday, the firm actually removing its timeframes for its long-term goals due to broader macro factors. You can see that the stock absolutely getting punished right now, down 12, now 13%, Shonali.
Yeah, I'm looking at Apple here as well, getting punished once again this morning, down more than 4.5% at the market open. They have shipped about 1.5 million phones from India to the United States in an effort to beat President Donald Trump's tariffs, according to a Reuters report.
And let's get a check on the overall Mag 7 index. I think it's BM7T index on the Bloomberg terminal. It is down right now about 3%. This is on the day. If you look on the year, we're still looking at double-digit losses even after yesterday's big gains. Let's get a closer look with Caroline Hyde. She is, of course, the co-host of Bloomberg Technology, and she joins us here on set. So, ripping face yesterday, and,
nice way of putting it.
And not really giving up so much today in terms of the mega cap tech stocks.
I mean, considering it was the best day for Apple since 1998, and you're only down 3%, a bit of profit taking is going to be totally unsurprising. Same too with Nvidia, off by about 3%, having soared since May 2023, but still up more than 20%. Tesla up more than 20% as well, having its best day since 2013. These stocks ramped hard, even though they remain exposed to China. And this is what everyone's trying to get their grips with. Morgan Stanley saying with Nvidia, look, the tariff chaos isn't over yet for Nvidia in terms of the overall macro pullback that you might see in terms of spending on AI more broadly. You've got Apple. You were just saying, Shonali, what a fascinating story coming out of Reuters more broadly. 600 tons of iPhones managing to be shipped, all the memes about all of the airplanes coming over and on airplane mode. But all of this is just, do you like that? But more broadly, this is a company that's going to have to navigate how much really can they send and sell us via India. They still have about, 90% of their iPhones made in China, according to Dan Ives. You've got Dan Dolev thinking that's maybe about 85%, but whatever you call it, bulk being assembled in China. They've got to re-navigate. They ain't bringing their manufacturing to US for the iPhone.
Well, you make a great point. I mean, Matt, you said that there was indiscriminate selling. Now there was indiscriminate buying yesterday. Those companies, a lot of the tech companies that we saw rally, are exposed to China. I want to talk about what's going on in China's stock market, though, because I noticed some of their e-commerce ADRs were popping this morning. What is the outlook there now?
Well, the consumer may be a little bit more buoyant if they get the stimulus that the government is now trying to navigate. If you're going to put this much pressure on a macro economy, well, you're going to get a macro response coming from the government trying to give the stimulus, and therefore PDD is going to go a little bit higher. These companies that operate e-commerce like Alibaba, maybe they will get a little bit more support. And of course, the local domestic EV makers, many feeling that there's going to be a flock to BYD, to NIO, if you're going to be a push against Tesla, for example, from a political standpoint. So maybe some of those domestic names start to rally a little bit, and that's why you're seeing like the Golden Dragon Index, the Nasdaq Golden Dragon, which is some of the top performers, the internet names in China, traded here in the US in terms of ADRs, that's on the higher side, even though the NASDAQ is pulling back.
You know, it's interesting to make a case for Apple, for example, just yesterday, despite the China risk, that idea that Goldman dropped their recession call after the changes.
Didn't take much.
Didn't take much. I mean, you know, if you're less worried about a recession all of a sudden because of a pause in tariff escalation, fine. But speaking to that pause, how are companies now navigating that next set of 90-day uncertainties?
Well, Apple's got to be rethinking how they, of course, use India, use Vietnam, use some of the other countries that they particularly outsource to. But what's so interesting in terms of the stockpiling that was done, how many more of these jumbo jets are we going to see full of iPhones? When you think of what's happened with TSMC, the numbers were stark overnight. They did phenomenally well. Their quarter, 42% increase in revenue for their preliminary numbers. This is the chip maker for Apple. This is the chip maker for NVIDIA. And they saw a real push forward in terms of buying and trying to onboard and get your inventory in check. That's likely to continue into the next 90 days. So their next quarter is looking really rather rosy. Interestingly, analysts are thinking, look, in the longer term, the AI spend, the commitment that you're still hearing from NVIDIA, from the likes of, well, Amazon, for example, in an investor letter, we're likely to still see the AI trade work.
Caroline, great having you here with us today. Thank you so much for joining us, and we'll tune in to your show at 11. Joining us now is Andrew Sliman, Senior Portfolio Manager at Morgan Stanley Investment Management. And I guess, you know, your head, like all of our heads, must have been spinning yesterday. Even if you expected President Trump to blink, that rally was unreal. What do you make of it?
Look, I think there's more certainty. I know this is controversial. I think there's more certainty around the ranges the market will trade at today than there was yesterday at this time. And that is that 15% declines, they happen, not they're not that infrequent. You can have 15% declines, but 20% declines is when credit markets tend to seize up. And we got close, but we weren't at 20% declines, and the president pivoted. And because of, as he said, because of credit markets. So I think that puts a downside cap, somewhere at 4,900 on the S&P. I'm not, as I've articulated all year, I think this is a pause year for stocks. But I don't think it's going to be a real negative year, and I think the president just told you he's not going to let it get too negative yesterday and too many shorts. What I saw, the good news going into yesterday is at the beginning of the year, there was a lot of optimism.
Right.
Kind of strategists were predicting 6,700 on the S&P by year end, and a lot of that optimism had been washed out since last week. That's, as the market dropped, that's actually healthy. There's more pessimism. You don't want when everyone's optimistic, and that's what I saw at the beginning of the year. So I think it sets up better, but I still think, this is a trading year. It's not going to be a great year for equities. But what I learned yesterday is you got a president who doesn't want it to be too bad either.
Yeah, I like that framing. It's not going to be a great year, but it's going to be a trading year, and that certainly sounds fun for some people. With that in mind, I want to ask whether you would buy a dip here. You see the S&P 500 down about 2% at the open. You had Citi's Wealth Head come out and say, don't try to catch this knife. Don't buy this dip. Where do you stand, though, if this is a trading year?
Sure. So I'm really excited because on Tuesday morning, before this all happened, we sent out a commentary to our investors saying the market is down 15%. And based on history, because I don't think anyone really knows unless you have access to the Oval Office, you don't know what's going to happen. When the market's down 15%, the playbook says you are supposed to step up and add to your equity allocation. And by the way, don't do all of it, because if it's down 20%, you should add more, and down 25% even more, because at the end of the day, the returns off minus 15% declines or greater 1 year out are better than the normal average return for equities. So to answer your question is, I wouldn't be a buyer here, but if you miss that 15% first step, I think you might have a second chance. I think there's a good chance you'll have a second shot at it. I don't know if it's going to come in the next couple of weeks, but usually the playbook, Sonali, is the market rallies off the low, and then the VIX comes down, so the uncertainty recedes, but the market kind of bleeds back lower to a previous, for kind of previous low. And if that's down below 15%, yeah, I think you'll have another chance. I just wouldn't chase it here after yesterday.
One question I have is how much you are watching the headlines. We were all sitting here yesterday morning when Donald Trump was tweeting about having to buy stocks or saying that you should be buying this dip, right?
Posting on Truth Social.
Right. Truth
That was
Social.
a huge moment. That was a huge moment.
Do you listen to that? Do you watch him post on Truth Social and follow him as though he's the one that's giving the ultimate financial advice?
Well, I mean, just think back to the great financial crisis of '08. It was a snowball that politicians couldn't reverse because of all the internet connections of derivatives. They couldn't stop it. So it ended up being a very, very bad for the economy and very bad for the stock market. This is very different. As we learned yesterday, one politician can change everything. And that's what we learned yesterday. So yes, you have to have, you have to know what's going on, because this is the markets are being driven by what's coming from, the White House. So I think it is very, very important. And that's why it's my belief that we learned yesterday that 4,900 is probably a low level that won't be breached, because that's when credit markets tend to seize up down 20%, and we learned that the president doesn't want that.
Andrew, great to get some time with you today. Thanks so much for joining us. Morgan Stanley's Andrew Sliman, I guess, holding our hands through these volatile market times. Some more stocks, some more movers on our radar today. Prada agreed to buy Versace for $1.3 billion. Constellation Brands issued downbeat guidance due to tariffs and muted demand. And then tomorrow we get bank earnings. I got to pay special attention to all this stuff because I'm playing against Shonali a little later in the pointed quiz.
My poker hand has a flush in it.
Nice. I think you're going to win this. We're doing this pointed thing. You know what pointed is?
Yeah,
it's
I
like
love pointed.
A quiz on Bloomberg.com.
It's a new Bloomberg.com quiz. It involves leverage. It's super Bloomberg, but it's super fun.
All right, so we'll be doing that later on. And coming up, U.S. President Donald Trump says U.S. Steel should remain an American company, pushing back on its potential $14 billion sale to Japan's Nippon Steel. We'll have the latest with Joe Doe. This is Open Interest.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Comcast getting downgraded to a sell over at BNP Paribas Exane. The firm citing earnings risks in areas such as advertising and media. Next up, we have Carnival actually getting upgraded over at Morgan Stanley. The analyst says that most of the bad news is already priced into cruise stocks, but you can see currently down about 8%. And finally, we have Ford getting cut over at Goldman Sachs. Ford is especially vulnerable to Canada's 25% retaliatory tariffs, since the majority of the cars that it sells in the country are manufactured in the U.S., Shanali.
And let's turn to another stock that we are watching, U.S. Steel, because President Trump says the steelmaker should not be owned by a Japanese company, suggesting that he does not support Nippon Steel's $14 billion bid for the steelmaker. Bloomberg's metals reporter, Joe Doe, joins us at the desk. You're seeing a big drop-off, and the reason you're seeing a big drop-off is because you saw a big boost the other day when he called for a review of the previous CFIUS review, didn't he? It's confusing, the messaging.
I mean, you really cannot make this stuff up. I haven't seen anything like this. We've followed this since August of 2023, and it's been a wild story since then. Monday, when the president came out and did the order to re-review the CFIUS review, a day later, Ancora, the activist investor, says they're actually withdrawing their activist, trying to nominate the board and put in a new CEO. And it felt like kind of for the first time, like since March of 2024, that this deal might actually have a chance. And you were talking to the people invested in the stock, and they're like, well, this is pretty good. And then after a great day in the markets, right, you know, the stock jumped up to $46 along with everything else. That's the highest we'd seen since March 2024. The president comes out in the Oval Office and amid talking about steel generally, says this about U.S. Steel. And the stock immediately dropped off after hours by 16%. And I started getting calls and texts just saying, what the F? Right? I mean, this is really hard for investors to understand. The president has said, listen, I don't want U.S. Steel to be owned by a Japanese company or any other foreign company. He's made that clear. But the fact that in the background we had reporting that Lutnick was meeting with Nippon Steel and the activist investor, it felt very much like a Trump, let's get the deal done type of thing. But obviously he came out yesterday and said what was on his mind.
Well, I mean, I think it's pretty fair to say that on both sides of the aisle, steel is considered of national security interest, right? We have to have our own steel makers, but we do have others, right? We have Nucor, we have Cleveland Cliffs, we have Bethlehem Steel. So do we need to have U.S. Steel? Is that important for national security just because the letters U and S happen to be at the front of the name?
Listen, you don't want like a company to just go bust, right? And to be clear, U.S. Steel will not go bust if this deal doesn't happen. Like, this is not a company that, by the time the deal started to happen, it wasn't like U.S. Steel was where it was in 2015, there were serious questions about whether or not this company could survive. The company since then bought a bunch of mini mills down in Arkansas. They doubled the capacity down there. Investors liked that narrative. That narrative is what attracted so much interest in the market to buy the company. Listen, U.S. Steel is here. It is here to stay. The question is, how is it here to stay? Does Nippon Steel ultimately get this deal? I don't know. There's a 45-day review by CFIUS that's going to happen. The president then will make a decision. It's just that yesterday, the president came out for the first time in what felt like nearly 2 months and gave his latest opinion, which was Japan should not have a majority stake in this company. I don't know what to tell you guys other than it could change tomorrow or the next day, or he may actually just kill the deal. We just have to wait and see.
Well, we'll have you back when he does. I'm sure we'll see you again soon. Good luck covering the ins and outs here. That is Bloomberg's Joe Doe. Now coming up, investors hitting the brakes on CarMax after the company missed fourth quarter estimates and pulled its financial targets. We'll take a closer look next. This is Bloomberg Open Interest.
This is Bloomberg Open Interest. Let's get a check on stocks right now. We're seeing down moves after the absolute hysteria that accompanied buying yesterday. The S&P was up 9.5%. The NASDAQ was up 12% and change. So these moves down, normally, 2.25% off on the benchmark index would be a real problem, but they don't look so bad compared to what we saw yesterday, holding at 53.35. In terms of absolute levels, that's not great. Let me look quickly here at yields, because this is important to watch. We're going to talk to Richard Farley about leverage loans and the credit markets. A lot of people talking about a potential train wreck there, but it looks like that's been averted as well. In terms of individual stocks, you can see we have moves down across the board here of the big heavyweights, NVIDIA and Apple, Ford and General Motors off, as well as Stellantis and Tesla. A lot of car stocks there because we want to highlight CarMax right now. That stock sputtering after pulling the timeline of its financial goals due to macro uncertainty. It also reported worse than expected fourth quarter results. Bloomberg's Craig Trudell joins us now, our global car czar. And Craig, I figured CarMax has an ace up its sleeve because prices are rising quickly, both in the new car market and the used car market. Do they not profit well from that?
I think that may be a big part of why we're seeing the reaction here, because you would and you have seen analysts come out and say, look, this could be a company that's essentially a refuge from all of this chaos when the new car market is going to have this big disruption, this big inflationary event. It's going to lead to a lot of consumers being priced out of the new car market. They're going to go to the used car market. And here's a company that's sitting on, an awful lot of vehicles that just got a heck of a lot more valuable. I think, of course, there's more to the story than that. It needs to go out and acquire more inventory for the used cars it needs to sell, and the wholesale market is going to be sort of turned on its head by all of the chaos that we've seen out of the Trump administration. So it's not necessarily as clean a story as it might seem to be, sort of on the surface.
Craig, what are the cross currents here? It's a great distinction to make between the used car market and the new car market. But ultimately, when you think about the state the consumer is in and potential pains, we're going to see it in the next couple of weeks from some of the big lenders here. Can consumers afford new or used cars with leverage in this coming environment?
That's a great question. I mean, just yesterday I saw a headline out of Edmunds, which is a car market researcher, where they noted that in the first quarter we saw a record share of new vehicle loans taken out that were 84 months or longer, and that is just sort of incredible. That I believe it was more than 20% of new vehicle loans taken out in the quarter were of that length of term, and so the consumer is absolutely stretched. We're seeing that in a lot of places, but in the car market in particular, especially since, to your question, the car market has never been sort of more unaffordable to the consumer than it has been the last few years.
Craig Trudell, our global car czar out of London, thanks very much for joining us. By the way, fantastic story by Gabby Coppola on the Bloomberg terminal about Audi's best-selling car. In the U.S., it's the Q5, right? A kind of compact SUV. But since it's put together in Mexico and they're not USMCA compliant, they're going to be a total of 52% tariffs on that vehicle.
That is quite the sticker shock.
That's unsellable.
So buying the tiny cars are not going to get you away from buying a more expensive car per se. Guys, can we check on these markets quickly? Because you were seeing almost every sector in the red today. Yes. A lot of negative feelings out there after that big rally we saw yesterday.
Indeed, you can see the S&P 500 down 2.5%, but still, that's not doing much to erase that 9.5% gain yesterday, though. As Sonali pointed out yesterday, we are still in the red for the year, Matt Miller.
Yeah, coming up in the next hour, Richard Farley joins us on credit markets. Did they almost seize up? Mandy Sue joins us on the options market. Plus, AOL co-founder Steve Case talks to us about venture capital. This is Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, stocks slide. A surprise slowdown in inflation does little to calm concerns that tariffs will bring lasting economic damage.
Another test comes tomorrow with JP Morgan, Morgan Stanley, and Wells Fargo all set to report earnings.
Plus, what does all this volatility mean for investment, innovation, and American competitiveness? We'll ask AOL co-founder Steve Case. All of that and more coming up, but a check on these markets. The bounce down in effect right now. The S&P 500 down 2.6% on elevated volumes. The NASDAQ 100 down 3%. Just for context, you probably already know this. The S&P 500 up 9.5% yesterday. The NASDAQ 100 up 12%. So it's natural to see some of that enthusiasm drain out a little bit here. The 10-year yield is an interesting one at 4.3%, down 3 basis points or so. You really didn't see a huge reaction in the bond market yesterday to that pause that we saw from the president, Matt, at least in the Treasury market, certainly not relative to what we saw in the equity market.
Yeah, I think the Treasury market is the most fascinating, even though you have a big superlative on equity markets, right? We saw a 10% rally.
Yeah.
That's mind-blowing.
Yeah.
But more people have written in saying they're really concerned about the credit market, which is why I wanted to bring on our next guest. It's time for the Wall Street Beat. Credit is holding up seemingly well amid the recent volatility over President Trump's tariffs. That's according to Goldman Sachs chief credit strategist. He spoke earlier today.
Not all crises are credit crises. Violent as the price action has been, I do take comfort from the fact that the microstructure of the market, or the plumbing of the market, has actually held up very well.
Now, on the other hand, a viewer just wrote in and said, we missed getting hit by a train in the last 36 hours, but the long end direction of travel is likely to be up and up. Liz Truss moment is not hyperbole.
So on the 10-year yield is up and up.
That's, yeah, or the 30. That is a little bit spooky. Joining us now is Richard Farley, partner and chair of the Leveraged Finance Group at Kramer, Levin, Naftalis, and Frankel. He's also the author of a new book called Drop Dead, all about corruption in New York City during the 70s. We're going to talk about that book, Drop Dead. But first, on the credit market, my buddy who wrote in said, I'm really trying to unpack this in a quiet room devoid of emotion.
Oh, boy.
Yeah.
How bad was it?
Well, look, you can't watch the equity markets day to day. The bond market, the Treasury market's a little more sophisticated. The syndicated loan market's very sophisticated, right? These are institutional investors, professional investors, and what you've seen is a consistent pulling back of risk over the course of the year until there's resolution on the trade issue. And it's not just tariffs, it's trade holistically. And if you look at the 10-year, it has not been that volatile, but the yields have come down. Now, some of that may be flight to safety. The inflation prints have been pretty good. The syndicated loan market has traded down significantly, okay? In January, 78% of credits were at par or higher. Yesterday, even after the pause, it was around 3%. So that's a significant pulling back of risk. And it's the old story. If I have 10,
that's huge.
If I have 10 containers on the shelf and 9 of them are single malt and 1 is poison, you're probably not going to buy any of them until you know which one. And I think that's where the riskier end of the credit markets are behaving right now.
Well, one thing,
and it's a bifurcated market. If you're not overly exposed to trade and your fundamentals are otherwise okay, there's probably no better time to be accessing now, particularly with the large amount of dry powder in private credit that needs to be deployed.
We'll talk about the good stuff in a second, because of course this is the environment where, like, Apollo, Oaktree, they do very well. But with that said, one thing Jamie Dimon said yesterday on Fox Business that caught my eye was that there are already hung deals out there. Banks tend to lose money on hung deals. There are quarters, guys, where JP Morgan brings in $1 billion in debt underwriting alone.
For people who don't know what hung deals are, like,
it's deals that they're not able to get off their books.
Okay.
Yeah, banks don't commit to these deals because they want to hold the loan in terms of LBOs. They want to distribute those loans to the market and make fees. Okay? Now, yes, there are hung deals in this environment because there's been a pause, but if you look at the size of that pipeline, it's relatively modest. It's about 10 to 20 billion. Okay? If you look at what it was in 2007, 2008, for example, it was probably 5 or 6 times that, and that's on a non-inflation adjusted basis. I think it was about what it is now. Okay? Now, if you look and see what happened to those deals that got hung, if you look at Twitter, if you look at the others,
took years ways to get past
If you were patient, you didn't get burned all that badly. If you panicked and sold into a bad market, you got hurt. So the good news is relatively modest pipeline, and two, there's no systemic issues out there in the plumbing. You can afford to be patient. And I don't see this as a 2-3 year issue, right? I think this is hopefully going to resolve in relatively short order.
Well, Richard, one place where you are seeing a lot of selling is in CLOs. I track the ETF space really closely, and one of the hottest corners has been these CLO ETFs, taking in billions and billions of dollars. It's really been a one-way trade into these types of funds. That's reversed. We're starting to see, or at least prior to what we saw yesterday, we'll see how it settles out, but we start to see some cracks start to emerge if you take a look at NAV discounts and the like. What do you make of what's going on there?
Well, look, I think looking at a day-to-day fluctuation in publicly traded vehicles and NAVs is also going to get you a skewed result. I think you got to look at the market holistically. And again, the trend has been down, as we just discussed. But I think overall, it's a pretty stable base. And I think the fundamentals, once we get beyond these trade issues, are still strong. I mean, the employment numbers were great. The inflation prints are modest. The fundamentals are pretty good, given all that's going on in an exogenous sense.
Speaking to the bifurcation for a moment, because I do want to acknowledge once again, yes, it is a golden moment for a lot of people, but how many...
Golden age, I believe, is the term.
Golden age.
The president
golden
used.
age.
Yes.
But I want to point out that there is a lot of trouble under the surface. A lot of people are very worried about private markets, the flywheel effect. If things go wrong there, banks are still exposed because the banks lend to the private credit firms. So how many of your clients right now are calling and asking for restructurings?
We have not seen a huge uptick in that over the past couple weeks. So that really hasn't happened yet. I think it's more a pulling back of deployment of risk, much more so than people worrying about performance of existing credits. So I think the original issue, deal flow, is going to be subdued until these trade issues get resolved.
I do want to talk a little bit more broadly about private credit, though, because, you know, for those who don't follow it as closely as Sonali, there's just this lingering suspicion, worry that, you know, because we can't look at it so easily, we can't watch, you know, how it's trading day to day, that maybe something bad is brewing there. I mean, how are you thinking about those sort of high-level concerns that remain out there?
Well, given the talent of your reporters, the minute there's any hint of trouble, I'm sure it'll all be uncovered very quickly. Look, these managers are regulated by the SEC. They report to investors. There are a lot of eyes on all these investments. And like I said, it's a professional market, and the people putting their money in, believe me, they're keeping a very close watch on all this. So I think if there's a systemic issue there, you're going to hear about it pretty quickly.
I want to ask about your book. So we're done. Let's put a bow on the credit thing and then move on, because this is your third book, dude. I've known you for 10 years. You've written 3 books in quick succession. This one isn't the same as your other 2, which were more Wall Street focused. This is about New York City.
Well, all of them are about a financial crisis of one form or another. And again, this is the 50th anniversary of the 75 fiscal crisis in New York City. It's a good time to discuss the issues. A lot of mythology out there. If you ask even an informed person about it, they'll say 2 things. One is President Ford told the city to drop dead, and Felix Roden came in and saved the day. Well, that isn't quite exactly what happened. Ford bailed out the city. He was always going to bail out the city, but he got blamed for it, and he got no credit for it because he was outfoxed by 3 Irishmen. One was Hugh Carey, the governor of New York. The other was Tip O'Neill, the House Majority Leader. And the third was a fellow by the name of John Patrick Scanlon, who was a PR genius and a semi-rogue. But again, the rogues back then were a lot more interesting and colorful than the rogues today. They hung out late at night. You could sit down with them, have a drink up at Elaine's today. The rogues are in bed by 11 o'clock and up at 6 a.m. doing Pilates. So, I mean, it's a much more treacherous world. But there are a lot of great characters, and it's a very interesting story. And when you see what actually happened, it's much more interesting than the myth.
Feels like the bonfire of the Vanities precursor moment here. You got the 70s, they've got the 80s down. But, you know, for you, a lot of people look at the 70s and say there are parallels to be drawn to today.
Yeah, look, if you look what happened in COVID, right, we all learned that, hey, you can do a financial services job anywhere. And the taxes and the weather are much better in Texas and Florida. So there has been a migration of jobs out. Now, the fiscal crisis was the migration of industrial jobs out of New York City. But now we're seeing the move of the financial jobs. And of course, the financial sector exploded at just the right time to save the city. Is there going to be something else that comes in to replace the loss of the financial jobs? And that's, to me, the biggest risk. So just keep an eye on that. And we were talking about Larry Fink and his speech at the Economic Club. He had mentioned that the growth in jobs at BlackRock had been disproportionately outside of New York. So that's what you need to keep an eye on.
There you have it. A lot of big existential questions there. Before we let you go, I do just want to ask about your process, because what is the size and scope? 3 books in how many years?
It's like 6 years, right?
Well, a little more than that, about 8 years.
You had Gonzo Wall Street was the last one. What was
Wall
the first?
Street Wars was
Wall
the first
Street Wars
one.
was the first one, yeah.
Well, how do you find time? I'm asking actually for myself.
Right.
I'm working on a novel. It's fiction, though. How on earth do you find time?
Well, you need a respectable excuse to not spend time with your family. So writing a book is perfect for that.
All right, there you go. Richard, it's always great to see you. That is Richard Farley of Creamer, Levin, Naftalis, and Frankel, and the author of Drop Dead. Meanwhile, let's get a look at some of these stocks moving this hour, and we have to start with Apple. Reuters reporting that the company has shipped about 1.5 million iPhones from India to the U.S. in an effort to beat the tariffs, still down 3% there. You take a look at CarMax, you can see it is lower by 17%. We have been talking about how it pulled its long-term financial goals, and it doesn't seem like investors like that. And boy, we are just looking at U.S. Steel as well, also down 7%, the deal that never ends. This is Open Interest.
Let's get now to high interest. Look at what's making headlines around the world. White House National Economic Council Director Kevin Hassett says that trade talks with some U.S. counterparts are advancing well. He says about 15 countries have made explicit offers that the U.S. is studying and considering. Hassett did not specify which countries were involved in those talks. Now, it's a Bloomberg scoop. The Audi Q5 is the German brand's top-selling vehicle in the U.S., but now it's unsellable in America thanks to these tariffs. 3 separate tariffs hitting the model, with the total fee coming in at 52.5%. This car is emblematic of just how globalized automotive supply chains are. Some of the Q5's engines are sourced from Hungary, transmissions shipped in from Germany. Dozens of local suppliers provide other components. And the world's wealthiest people added $304 billion to their combined net worth yesterday after President Trump said it's a great time to buy stocks. In the largest one-day gain in the history of the Bloomberg Billionaires Index, we saw winners like Elon Musk, Mark Zuckerberg, and Jensen Huang. Katie?
Well, volatility remaining high today in these markets, despite plunging during that big face-ripping rally that we got yesterday afternoon. You saw a record $30 billion worth of shares traded, but the gains largely driven by low liquidity and also aggressive short covering. Joining us now for more on these market swings is Mandy Zhu. She is Cboe Global Markets Head of Derivatives Market Intelligence. Great to see you in person, Mandy.
Great to be here.
So we were talking about this sigh of relief, and we pointed to the equity market, but it was really a cross-asset move. Where did we see the most relief coming through?
Yeah, so yesterday's rally, not surprisingly, led to a decline in volatility across asset classes. You know, the VIX went down almost 20 points. But where we actually saw the biggest decline, what I thought was interesting, was from the credit market. If you look at our credit VIX index, VIX IG, which tracks the volatility in the CDX options market, investment grade, that fell by far the most and is trading just above its long-term average. So the credit market right now is signaling almost average levels of volatility, expected volatility going forward, which, given the backdrop, I think that move may be overdone.
So how are investors looking to play the future right now?
Yeah, I think what's interesting, well, the 2 things I took away from yesterday's move. The first is just kind of how the incredible intraday volatility and how headline-driven we are. And I think that's going to really put upward pressure on volatility or help stabilize VIX at current levels. And the second thing I thought was interesting is, for all kind of, the Trump saying that we don't look at markets, they obviously care, right? And that means potentially that some of the downside tail risk in the market that was really people were looking at may be reduced in this environment.
They reportedly were concerned about the 30-year yield jumping up above 5%. Have you noticed a lot more interest in the Treasuries market over the last couple of days?
Yeah, so we've seen incredible options activity in TLT, which is the ETF that tracks 20-plus year Treasury options. And actually, what's interesting there is, for most of the past 2 months, TLT options were signaling more fear of downside in yields, so more fear of recession risk. And over the past week, that has flipped, so now that puts are trading at a premium to calls, signaling more fear for inflation. So that was a pivot that I thought was interesting. The bond market, up until very recently, more concerned with recession risk, now turning to focus more on inflation risk.
Interesting. I mean, we got CPI this morning, and it was pretty quiet, but as we were talking about with Mike McKee, it feels like everything that's not real time is still. We're finally showing the VIX IG there, and you can see that real sigh of relief really coming down. But I want to talk about where we stand right now. You mentioned the flip that we're seeing when it comes to TLT positioning. Where else have we just seen a washout? I have to imagine that a lot of people were just blown out of positions yesterday.
Yeah, so I think, again, I mentioned volatility declining, just collapsing across asset classes. To me, what really stands out in this environment, I think short-term vol likely to be supported given the high intraday volatility, the high realized volatility that we're seeing. To me, the decline in longer dated volatility is maybe overdone or underpricing potential longer longer term risk, right? So I think what Trump has done is pushed out a delayed potential tariffs, prolonging the uncertainty and potentially exacerbating some of the economic impact. As we know, uncertainty really kills markets and really kills the economy. So if you look at S&P 1-year implied volatility, it's trading just 1 point above its long-term average, right? And typically it's trading around 20. Typically in recessions, it's as high as 40. So the options market is really not signaling any risk of a potential more prolonged downturn in the economy.
But what are you looking for in terms of moments that investors are willing to take on far more risk? Of course, yesterday was a big risk-on day. You're seeing some of that really popped out of the bubble today, some of it. But is there a marker here? Are there dates that people are looking for? What's the next catalyst to really put those large trades on?
I mean, the most obvious is the 90-day, right? The 90-day delay. But honestly, I think yesterday's price action just tells you that we're all kind of held hostage to the whims of one person, right? So the next tweet, the next press conference, these could all be volatility catalysts. I think that's why you're seeing short-term volatility really starting to pick up today after that collapse yesterday. As people were understanding it's not over.
It's so funny. On the one hand, there were a few people, Bob Michael was one, talking about the potential for an emergency Fed intervention. On the other hand, it seems like the Fed hasn't mattered less in quite a long time.
Yeah, and I'm a little skeptical about emergency Fed intervention just because, as we saw yesterday, things can really change on a dime, right? So the Fed comes out and cuts, and if Trump then presses back on the trade war, then what happens to the economy, right? So I think that uncertainty is really what is going to really have the most negative impact, and that should be reflected in longer dated volatility in the options market, and that is not what we're seeing right now.
What's going to be really interesting to see how the next 90 days or so go. Mandy, it's great to see you on Today of All Days. That is Mandy Zhu of Cboe Global Markets. Meanwhile, a quick check on these markets, now open for just about an hour or so. You can see the S&P 500 down 2.9%, really giving back some of those gains that we saw coming in after 1:20 p.m. yesterday. The NASDAQ 100 leading losses. Big tech really taking a hit right now. Still very exposed to China, as Caroline Hyde mentioned to us, down 3.5%. And the bond market's still pretty quiet, but a little bit of a rally. We'll continue to track all the market moves. This is Open Interest. Welcome back to Open Interest. Let's get a check on these markets right now. You can see selling in vogue on this Thursday. The S&P 500 down 2.6%. We're off our worst levels of the session. Now, it's hard to look at these moves knowing that yesterday was such a huge day. It's only natural that you would expect to see some of that enthusiasm that came through yesterday to be wrung a little bit out of the markets today, and that is certainly what's happening in big tech. The NASDAQ 100 off by about 3%. The bond yields on the 10-year Treasury yield also down a little bit, about 2 basis points. We've seen a lot of gyrations there, to put it mildly. But guys, let's take a look at the sector level. I think this is really interesting to highlight just how defensive the trade is today. You have 10 of 11 sectors in the red right now. Your sole winner on this day, the day after, is consumer staples, up about 0.7%. So even that isn't really seeing a lot of robust bidding going on.
88 of the more than 100 stocks in that NASDAQ 100 are in the red today. So defensive tone. To your point about the bond market, interesting also. That auction went okay yesterday.
It did.
There's another one today, a 30-year.
Yeah.
I think that'll be interesting.
I'm glad you brought that up, because it definitely got lost in the sauce, because we got that Trump Truth Social post about 20 minutes later. But you actually saw the S&P 500 spike a little bit after we saw that strong demand. Someone quipped to me that, you know, the U.S. is trading like an emerging market. When was the last time you saw stocks rally because a bond auction went over well?
A dearth, apparently, though, of direct bidders, of foreign bidders not buying U.S. Treasuries. So I think something that we can continue to watch. And I will remind everybody that even though we had this insane rally yesterday, we still haven't climbed back to absolute levels that most people were calling as a bottom.
Yeah.
Right? We haven't even come back to 5,500 on the S&P 500, and we were at 6144 at the end of February.
But at least we know where the strike price on that Trump put is. It's somewhere around 5,000, maybe 4,000.
Well, that's the question. Is it on stocks, or is it in the bond market? Was he watching the long end of the bond market rather than
We know
the
he
S&P?
was watching the bond market, but as Sliman made the point, I believe it was Andrew Sliman, the two are connected. If you see that 20% drawdown in the stock market, you're probably going to see some pain in the bond market as well. It was a good point.
Yeah.
We're going to talk about some good points with Steve Case up next. This is Open Interest.
He helped build the early internet as a co-founder and longtime CEO of AOL. Now Steve Case is investing in the next wave of American innovation through his venture firm, Revolution. We are happy to welcome him on Open Interest today. Steve, thanks so much. I wonder that we see these markets swinging. You know, yesterday was a massive up day. Today is a pretty big down day through Trump's trade war. What does this kind of volatility mean for investment, for innovation, and for the American competitiveness that you're working on?
Well, obviously the markets have been jittery. What the president called a little bit of yippee, and which I guess is good for ratings for business shows like yours. But most investors, most entrepreneurs, most executives find it confusing to figure out how to navigate. And in the long run, I think the American innovation engine is still quite strong. Obviously, America has a strong lead on new technologies such as AI. We're making some progress, need to make more progress, but some progress around trying to level the playing field, backing entrepreneurs in different parts of the country, what we've done with Rise the Rest. So that's all positive. But the bigger companies are starting to get a little more defensive. A few months ago, they thought maybe the door was open on M&A, and now they're maybe a little more nervous about that. The tariffs obviously create some uncertainty and risk, uncertainty about what happens in the next couple of weeks on the tax front here in Washington. So there's a lot of uncertainty. Not surprising, the markets are pretty chaotic. But if you take the long view, and venture capitalists, you have to be thinking more of 10 years out, not 10 minutes out. I think things are pretty well positioned for this next age of innovation, entrepreneurship, and America is well positioned to continue to lead.
Yeah, Steve, you make a number of great points there. I mean, you think about all the optimism that was built, not just around M&A, but IPOs, exit opportunities of that type. It certainly feels like a long time ago that we were talking about that. But, we've been chatting about how you think about the big tech companies, the Magnificent Seven, how exposed they are to China, how much of their cost of goods sold comes from China. I know that you're confident in the long term here, but take us into how exposed the average tech, the average AI startup is to what's going on at the global scale.
Well, it's kind of a mix. It kind of depends on what the company's doing and whether it be AI or other technologies, how they're using it. The ones that are more software, kind of pure digital, companies, it's less an issue. The ones that have a hardware component is much more of an issue. I happened to talk to an entrepreneur yesterday who's launching a company in the fall. The manufacturing of that product, it's a hardware, software, service kind of hybrid product, is in China. And suddenly looking at 125% tariffs potentially obviously creates significant risk and uncertainty, which will impact pricing and even try to think about where else they should manufacture. And the larger companies like Apple that obviously are reliant on manufacturing in China, there's more risk there. But most of the innovation economy, most of the sectors that we're backing, they're less focused on tariffs because they aren't necessarily manufacturing in China or some other country. There may be some components that they need for some of their products or some of their infrastructure, but it's less of a front and center issue. The entrepreneurs typically care about access to capital. How do we get more capital, and particularly outside of the major tech hubs like Silicon Valley? Even we saw in the election, President Trump won 31 states, but if you add up all the venture capital that went to all 31 states, it was only 16%, 1/6. So those states really are underrepresented in terms of venture capital. Therefore, it's harder for the entrepreneurs to start there. You don't see the same job creation, economic growth there. And so we do need in this next phase, not just to make sure America continues to lead the charge, as China and others step up to the plate around this next frontier, but we also do it in a way that brings along more people and more places, so we have a more distributed innovation economy in our country, not just a few big tech hubs doing well and lots of parts of the country being left out and left behind.
Right. I want to double down there for a moment. Access to capital, because of course investor sentiment has been very bruised of late. You also see that capital markets freeze, really the IPO market not opening up as investors had hoped for or expected this year, and the number of public companies just shrinking. So what does this mean for younger companies? Is there as simple as a valuation reset, or is there something more existential going on?
I think we've seen progress last decade, including around Rise the Rest. 1,400 new venture firms were started in these rising cities, so that's good. But the challenge is, are they going to be able to raise a second fund or a third fund? Access to capital for venture funds has gotten harder, just as access to capital for the startups, the entrepreneurs, has gotten harder. So that's a challenge. As you know, the public markets have we've seen a reduction in IPOs. There was a little bit of a boom a decade ago. I was working on the Jobs Act that passed, I think it was 11, 12 years ago, that created a better path for emerging growth companies, and you did see more IPO action. But it has slowed, in part because of the risks and costs associated with being public, and I know Congress has taken a fresh look at that, but mostly because the late-stage private capital markets have been so robust, companies could raise whatever amount of capital they needed to fuel growth without having to go public, which is different. When companies like mine, AOL, went public, or Microsoft went public, or Amazon went public, their valuations tended to be a few $100 million, and they're raising tens of millions of dollars in their IPO. Now those companies are able to do that in the private market and stay private for much, much longer. Now, there also is a little bit of a reset in those late-stage growth markets, and so that will result in some companies having to look at a public option maybe sooner than they otherwise would have. But it's not just about the regulatory policy around IPOs. It's also, is it a path that you need to consider to have the capital you need for this next chapter in your journey, or can the private markets achieve that for you?
Yeah, it's a structural change. But I mean, even with that in mind, I want to talk about some of the investments that you do have right now, because you've invested in the likes of Kava, Sweetgreen, which actually our team is eating after the show today. Both of those went public and you were investors there. But when you think about some of the investments that you have in the AI space, do you have any IPO candidates in the pipeline, or are you waiting out the storm?
We do have some in the pipeline. One company that went public about a year ago, Tempus AI, focused on healthcare, done quite well. They're using AI and genomics to create a more precise way to diagnose disease, and doing a lot of things with data in partnership with a lot of pharma companies. It's a great company based in Chicago, founded by Eric Galkowski. So they have had a successful public entry. They have seen their stock price gyrate, as many have in recent days, weeks, months. But the long-term trajectory for that company, I think, is very solid. And there are other companies that we have taken public that have AI as part of their strategy. Clear, for example, uses biometric technology to clear people faster through airports and other venues. We back some private companies that are using AI that are showing real momentum. And each of them will have to decide when is the right time to consider going public. It obviously depends on their specific needs, and not just access to capital, but are there some strategic benefits of being public, having more visibility, having more transparency, having more of a currency to use for M&A. Each company is a little bit different.
All right, Steve, great to speak with you. Really appreciate your time. That is Steve Case. He's the chairman of Revolution and the co-founder of AOL. Let's get back to these public equity markets. You can see that we're off our worst levels of the session, but still in the S&P 500 down about 2.3%. As we've been discussing, it's big tech that's leading losses today. Volume is elevated, Shanali, relative to our 20-day average, but compared to what we've seen over the last few days, it certainly seems a lot calmer out there.
Right, it's wild to feel that 2.4% doesn't feel like a lot based on what we have been dealing with. Let's get a look at stocks moving this hour with Bloomberg's Isabel Lee, because a lot is moving.
A lot is moving. So we can look at Carnival. It's edging almost 9%. So this is interesting because Carnival has upgraded to equal weight from underweight at Morgan Stanley. The company said that a lot of bad news seems to be already priced in given the share price decline. So basically Carnival's risk reward is now fairer. They did reduce their price target from $25 to $21. So cruise stocks, as we know, have seen really a huge drop this year. In general, they've averaged around a 41% decline from the beginning of the year. And I guess really, analysts say this in general, that in the event of a recession, you would really want to steer away from cruise stocks.
It is a bit unfortunate that they're saying the bad news is already in the price and it's down 8%. But
it's tough. CarMax is also getting more than decimated here, even though used car prices are going through the roof, and I guess this is because they can't maintain their forecast.
Exactly. So they're edging lower by almost 20%. So they backed away from the timing of their financial goals. So they said that they're making progress towards that, but they're just not issuing any timeline. So that is what's spooking investors. So they really just joined a growing list of companies citing the difficulty of predicting where their company will go, their bottom lines, their share prices in this uncertainty, this volatile environment. We also saw the company reporting a worse than third quarter estimates. But also, we know that the auto industry is more affected than normal than others. We have a 25% levy on them. So we have a lot of car buyers rushing to dealer lots.
Yeah, Matt Miller is keenly aware of that dynamic. So interesting moves in CarMax, to say the least. Let's round it out and talk about what's going on with Constellation Brands, because it has been quite a volatile morning in that stock.
Exactly. So when I first looked at it, it was in the red, and now it's in the green, fluctuating between gains and losses. So Constellation is a beer, wine, and spirits maker, and they issued a downbeat guidance, and they did say it's because of tariffs and just generally muted demand in alcohol. I guess people these days are drinking less, and the company expects earnings to be lower than expected for a 2026 fiscal year. And Truist actually said that they were surprised they even issued guidance at all, because as we've seen with other companies, they really aren't. But even before this whole tariff hullabaloo, they have been having weaker demand.
Hullabaloo has been called. I like that.
I can't even say the word. Isabel, we thank you so very much. That is Bloomberg's Isabel Lee. Now, coming up, the bank earnings parade kicks off tomorrow morning. We're going to preview what to expect with Stephen Bigger of Argus. This is Bloomberg Open Interest. Now, JP Morgan, Morgan Stanley, and Wells Fargo kick off bank earnings tomorrow. And policy and economic uncertainty are, of course, in focus. Joining us now with what to expect, Stephen Bigger, Director of Financial Institutions Research at Argus. a lot's going on, right? You had recession calls put up and then pulled back in the case of Goldman, for example, with the uncertainty around tariffs and the change in positioning. But fundamentally, we did see a lot of capital markets activity that was expected not come to the surface. Consumers are on high alert given the concerns around potential future inflation. How does that read through to the banks?
Yes, good morning. Well, certainly all true. I think the much hoped for recovery in capital markets has been put on hold for the most part. We've seen some very large IPOs expected to come, such as Klarna, that are now on ice. And I don't think yesterday's actions with the pause in tariffs is going to result in any great constructive conversations to improve that for quite a while until there's more clarity. So yeah, it is daunting for the banks at this point. I mean, it will probably overshadow what we think was a reasonable fourth quarter, or first quarter rather, with trends largely tracking those of the fourth quarter. But yeah, the conversation will certainly shift to what will likely be weaker loan growth, continued margin pressure, and now the question moves also to credit quality and what a downturn will mean there.
How concerned are you about that? Because we've seen reports from various Federal Reserve banks that savings and checkings balances are down, debt is growing, inflation-adjusted debt beyond pre-pandemic levels across all income levels. Are we making too much out of it? Because the U.S. consumer often proves skeptics wrong.
Well, certainly the soft data has pointed to some worry spots, consumer sentiment coming down, and we'll see if it actually does result in some weaker loan growth. I will point out that, yeah, this week has been two negatives for the bank group at large. On Monday, we got the consumer credit, particularly revolving and non-revolving credit, and non-revolving credit was down 0.3% for the month of February. That's weak. That's a number that very rarely declines on a month-over-month basis. It just continues to go up month after month, year after year. So that's a bit worrisome there. Even revolving credit, things like credit cards, home equity loans were up 0.1%. So you can't get much shallower than that on the positive side. And then just yesterday, as I think you're pointing out, the Fed results on the delinquency rates for 60, 90-day cards have moved up to a 12-year high. So it's hard to say that we're not making too much of it at this point. I think clearly a slowdown. The somewhat good news for banks, though, is that they have even last quarter mentioned that they were expecting a 2025 increase in unemployment for kind of the 5 to 5.5% rate. We're down here at 4.2. So they're fairly well reserved. They're expecting some weakness in the labor market in 2025. So I don't think we're going to get enormous increases in loss provisions. But later this year, and I think that's where the commentary will focus, how much they do need to set aside for that.
And Stephen, I want to get specific here and talk about some of the names in your coverage universe. I mean, you cover all the big guys, of course, JP Morgan, Goldman, Citigroup, Wells Fargo, the list goes on. Who do you think is best positioned in this environment when you look at your stable of coverage?
Well, you certainly tend to move back to the tried and true companies, the JP Morgans that have, certainly has the diversification of revenue sources, and they're tend to fare the best in IPO and with the league tables, and remain high in those spaces. Trading also, that's been the one certain positive in this environment is trading revenues have just been explosive. Given the volatility we've seen, not just in stocks, but in fixed income and currencies, commodities. So that will be a decent offset going forward if volatility remains. So that favors the Morgan Stanley and the Goldman Sachs type firms, but with a big offset with capital markets. So they're more of the pure plays there. And from a trading perspective, yeah, I would prefer the JP Morgan or even a Wells Fargo, a PNC, some of those large regional banks that have good service territories and and also have that revenue
I
diversification.
want to point out, it's fascinating. Goldman Sachs is down 13% on the year, whereas JP Morgan is only down just over 4%, less than 5%. Do you think that there's more room to fall for a JP Morgan or more upside at this juncture? Because even with that drop on the year, it's still trading at roughly 2 times its book value.
Yes, well, that's what you tend to get for banks that have premium metrics such as return on equity, market share. The price to books and PEs tend to be a bit higher for firms that have that consistency of earnings growth as well. So Goldman is going to show a lot of volatility in the earnings stream here as we move through these quarters and have this uncertain, particularly in the capital markets environment. So that's why the favorite sort of moves towards the more consistent earnings stories, which JP Morgan is one.
All right, Stephen, great to preview the big bank earnings with you. That is Stephen Bigger of Argus. Meanwhile, a check on these markets because the selling has resumed in the S&P 500. We're now flirting with session lows on the big benchmark, down about 2.9%. You can see that slide resuming and picking up momentum in big tech as well. The bond market has been pretty stable, and that continues. The 10-year Treasury yield only down about 2 basis points. This is Open Interest.
The retaliatory tariffs, you have a situation where basically production sort of grinds to a halt because there's these interdependencies, and that is very bad. It's almost like another COVID in that it raises costs, it lowers revenues for companies, and it worsens the capital markets.
That is Bridgewater founder Ray Dalio speaking earlier with Bloomberg's Francine Lacroix. Of course, his note this week has been making its rounds across trading desks. People trying to look at the long term here amid this short-term volatility. Another conversation I had yesterday was with Ann Walsh, for example, of Guggenheim, that's looking back to the Reagan era to think about how things might change in terms of the U.S. manufacturing base.
Yeah, I'm looking forward to hearing a little bit more of that interview, of course, with Ray Dalio. I keep coming back to Larry Fink. I believe that was all the away on Monday, which feels about a year ago with Eric Schatzker, though.
I listened to the whole thing.
I'm sure you did.
Yeah, at the Economic Club of New York.
Yeah, and I mean, some of the points he made, that the CEOs he's talking to are acting like we're in a recession. We heard that from the Delta CEO, that he and his peers are acting like they're in a recession. And you have to wonder, okay, we have this short-term relief, but what happens after 90 days? I mean, how does a business plan, even still, there's still so much uncertainty
And
here.
even if they are waiting those 90 days and have some sense of relief, if CEOs already believe we're in a recession, it pauses activity, it pauses hiring, it pauses M&A, it pauses capital markets activity. Right. It makes it very difficult. And to your point that you made earlier in the week, sometimes this becomes a self-fulfilling prophecy.
Absolutely. Human psychology, Matt Miller, it's a powerful thing. I was a psych minor in college.
I'm looking at, that served you well.
Kind of.
That was a good choice. I'm looking at Polymarket's odds right now at 53% of a recession. That's down from 65% yesterday, so a significant reduction, but still greater than half. And I have to say that if you're one of the big businesses, right, if you're a Walmart, it's a little bit easier for you to handle this kind of thing.
Yeah.
But we had the guest on who makes the electric guitar pedals.
That was awesome.
And I get messages every day, multiple messages from people who run small businesses, from people who run Main Street businesses, and say they cannot cope with what's happening right now. They are forced to raise prices, and they have no other choice because they can't rearrange their supply chains.
Yeah, I do wonder if you're going to see this interesting dichotomy when it comes to the market and investors on one side and businesses and CEOs on the other, because again, they're running a business. They have to think about capital expenditures and all that, employment as well. But then you have investors who are saying, okay, we have some relief. Let's just run with this.
Can we do something for you in particular, Katie, and pull up the Russell 2000 on the year? Because this was a trade that we were talking about last year. Investors were piling in. It's down more than 17% this year.
It's a lemon.
Pretty brutal.
Yeah.
And also, if you think about how much small businesses have been employers in the United States over the last few decades, it doesn't bode well for the job market either.
Yeah, it's interesting because, I mean, these are small companies. They're domestically focused. The idea was, the bull case was that they'd be more insulated from tariffs from some of these multinationals. Obviously, that has not panned out.
That's not the case. And I'm actually, though I'm talking about much smaller businesses than this, right? And the reason I think about it, yesterday you heard Scott Bessent on a competing network, I can't remember honestly which one, saying that it was Wall Street's turn, now it's Main Street's turn. And he was talking about for prosperity. The problem is these small businesses on Main Street that employ, 3, 4, 5 people, they're the ones who are having the most problems. Coming up tomorrow, Max Kettner of HSBC and Joanne Su of Michigan. This is Open Interest.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York and San Francisco, this is Bloomberg Technology. Investors, they are back on edge after President Trump's tariff pause and monster rally yesterday. And this as tariffs on China remain in place. Markets now bracing for a potentially protracted period of global trade volatility. Let's check in on these markets. We're currently up over the last 2 days, almost 8%. Remember the euphoria that swept through the markets as tariffs were put on pause. All countries except for China now have a 10% blanket tariff. But we drop again once again today, Ed, and it looks as though the anxiety about what China really means for the broader markets is still there.
Yeah, let's give some illustrative examples of the companies impacted, right? Tesla jumped 22% yesterday. This is a 2-day chart. It's pulled back today. So it goes from having its biggest jump since 2013 to pulling back. Apple, another company impacted, right? Switching up the boards and looking at Apple. 90-day pause on 56 countries that had tariffs implemented while the administration boosts the tariff level on China. Apple's so interesting, and later in the show we'll dig deep into it. Why? That Reuters report that they airlifted tons, literally 1.5 million iPhones from India into the US. This is kind of crazy markets news cycle, and I'm here for it.
Aren't we just? And President Trump's tariff pause is a welcome relief, Ed. But look, investors are remaining wary of the wider economic impacts of those 125% tariffs still on China. White House National Economic Council Director, that's Kevin Hassett, saying there have been well-advanced trade talks and offers with other nations. Bloomberg's Kaylee Lyons breaks it down. Just the intricacy, the 10% blanket tariff on everyone but China, but some get close to a deal, it seems.
Yeah, according to Kevin Hassett, who was speaking on another network, he's the director of the National Economic Council. They've already had more than 15 deals presented to them, and they are intending to take these bilaterally, one by one. The entire trade team, which could include Hassett, but as well as Treasury Secretary Scott Bessent and Commerce Secretary Howard Lutnick, and of course President Trump himself, who admitted yesterday that while this is about negotiation, it was also about the market, despite the messaging we initially got from the White House press secretary and Secretary Bessent that this was always part of the plan. This was the art of the deal. It's all about negotiations. The president himself admitted he was watching the bond market get a little queasy and felt that people were getting yippy, and that contributed to this move, at least to lower or to pause 90 days reciprocal tariffs on all countries except China. But yes, that 10% is still in place, and that 125% levy on China in place as well, in addition to the 84% reciprocal tariff that China has placed on U.S. imports. And that could effectively have the effect of starting a decoupling of the two largest economies, which obviously has major implications for firms with heavy Chinese exposure, including the technology companies that we saw ripping yesterday, as you guys were just talking about, giving back some of those gains today, as there is still risk here for a company like Apple and NVIDIA. And although President Trump said yesterday he does think China wants to make a deal, he's expecting a phone call from Beijing and would love to talk to Xi Jinping. There has been no sign from Xi or the Chinese government yet that they are interested in making that forward progress, suggesting that China does not necessarily want to blink first here, keeping in mind that the idea that there's still ongoing conversations over a TikTok divestiture deal adds an additional piece of leverage and complication to any conversations that are had.
You know, Apple's going to be a big focus in the show today because the White House keeps talking about it. Yesterday's jump, the biggest since 1998. It's just crazy times. And India's a focus. I was interested in our reporting that Bessent listed India as one of the nations he'd speak with early on. What is the DC reaction, right? If you're a Democrat and you're trying to respond to the White House tariff policy, what are you hearing?
Well, essentially what Democrats argue is that this is just chaotic, that there is so much uncertainty around the policy, and then that has the same detrimental impacts of these policies staying in place. There was also a lot of concern on the part of primarily Democrats yesterday about the potential market manipulative effect of President Trump's swings when it comes, or vacillations when it comes to this policy, keeping in mind that it was yesterday morning he said on True Social it was a good time to buy, then hours later sparked the biggest rally we've seen since 2008 with this decision, and many, including including Senator Adam Schiff of California, have suggested that this requires an investigation into possible insider trading. So that is another narrative we are hearing. All of it, though, just speaks to the uncertainty around this policy, keeping in mind that while the president is now saying that China tariffs are sticking in place, that there is a 90-day pause in place for other countries, we have seen time and again that he does have the power to change his mind and to do so very quickly. What stands today on Thursday isn't necessarily going to stand tomorrow necessarily. And of course, we're going to have potentially multiple opportunities to hear from the president today. He's scheduled to be holding a cabinet meeting right now, signing a bill later, presents some opportunities for him to speak to the press, and we'll see if he has any additional surprising tariff news for us.
Bloomberg's Kayleigh Lyons in Washington, D.C. Thank you very much. Another story overnight. China also announced it will, quote, moderately reduce the number of U.S. movies allowed into the country in response to the U.S. government's tariffs. The move is seen as a new front in the trade war and could signal Beijing's willingness to target American services, which could include travel, intellectual property, royalties, and transportation. Kara.
Still so much to digest on the wider tariff implications on tech. Let's get to it. Jay Hatfield's with us, Infrastructure Capital Management CEO. Can you trade in this erratic market?
You can, but it's very easy to lose a lot of money doing so. So it's really better for most investors is to hold their positions. Although I will say, we have been, even before the tariff halt, we had said that 5,000 was a good support level. So now that we've kind of bounced off that hard, I think we're just neutral on equities right now. But I would counsel even hedge fund managers to trade cautiously because there's erratic policy coming out of the White House. They can announce it at 1:10 in the afternoon. And so it's better to just get to your position and kind of hold it.
When you're thinking about potentially the names that you like and want to recommit to, how much are you thinking about exposure for China at the moment?
100%, I guess, and also to the overseas markets. So we favor, I think you had a guest on earlier, regional banks. They have no exposure to international. They do have credit exposure, but we think we have a non-consensus call that the economy is pretty strong. And so those banks have come down almost as hard as the investment banks, but they're not dependent on investment banking. They're really just dependent on rates and spreads. So be more conservative in this market.
Jay, I'm just staring at a 5-day NASDAQ 100 chart. And I'm staring at it because effectively net, we're flat over the course of 5 trading days. Then you think about the drama that were within those 5 trading days. Do you net understand the tariff policy of the White House, and are you able to make informed markets decisions based on your understanding of that policy?
Thanks, Ed. Definitely not. I mean, that's really why we're neutral on equities. We're actually very constructive on inflation, which that view is validated this morning. So we had negative headline inflation. And just to mention that, too, that everybody wants to talk about tariffs, but nobody talks about the 20% drop in energy. That's very profound. That's very stimulative to the U.S. economy. It's very positive for inflation, but it never gets mentioned. But to your point about uncertainty, there's basically 2 camps in the White House, the hawks and the doves. The doves are more pro-business. You kind of saw that when Elon Musk called Navarro a dumb bag of bricks. Like, that's almost unprecedented. I don't think that happens in normal organizations where colleagues are highly pejorative. So because we don't really know who's going to win that debate, it seems like Bessent has the latest victory. We are, like I said, we're neutral on stocks. We'd be more conservative, and also fixed income looks pretty attractive.
Jay, recession calls were pulled on the White House's 90-day pause. Should our audience of technology investors, technology employees, founders, startup leaders be braced for a recession in your mind?
Our call is there's no recession, but slow growth. But the real thing that also people are missing, in our opinion, is that the slowdown is mostly caused by hawkish Federal Reserve policy and not by tariff policy. As I mentioned, energy decline pretty much offsets the tariff increase. So the real issue is ultra tight Fed policy. We think the Fed has a flawed structure, policy framework. They're very dangerous, and they potentially could create a recession. But we do think the inflation data is going to be so positive, they'll be forced to cut rates later in the year.
I'm really interested in that U.S. economy positivity, basically, and the fact that that means maybe we've got a resilient consumer for Apple phones, maybe we've got a resilient consumer for Amazon products. Are there any stocks in the tech world that you think are worth adding to, not just regional banks?
Absolutely, and this doesn't sound conservative, but we think is more conservative. Amazon, they're kind of half Walmart, and they're price insensitive. They're just pass-through entity. And the CEO is on this morning saying that AWS demand is extremely strong. So they get traded like a tech stock, but they're half a retail stock, and they're cutting costs. So that's, again, like regional banks, pretty defensive in a market that has been destabilized by this White House that can't really sort out who's in charge.
Andy Jassy been putting out his investor and shareholder letter today and responding to some of the, well, current volatility that his consumers see, but then push us forward as to what your view is on AI, and if AWS still sees insatiable demand. Many have been trying to work out whether the AI bubble that has so inflated this market is anyway intact. Is it?
We think so. I mean, everybody looks at the market and says, oh, well, the stocks are way down, so AI must be falling apart. They're just high beta stocks. They have 2 betas, so they're twice as volatile as the market. So the market's going down. What do you sell? You sell the volatile stuff. You sell the investment banks. You sell tech stocks. This doesn't mean the AI market has changed. And that's one reason, though, because we do believe there will be continued AI spending, and Jassy's comments certainly validate that. Really, it's investment and not consumption that drives recessions. So AI spending is offsetting a slow housing market. And another thing that people haven't focused on, rates have come down 50 basis points. Yeah. It was disconcerting yesterday when they were skyrocketing, by the way. I thought the market might crash then. But that is helpful. It's not going to get the housing market to boom, but stabilize. So if you look at investment, you can predict recessions pretty well. Stabilizing housing, strong tech spending, that adds up to slow growth, say, in that 1% to 2% range.
Jay, our case study today, I think, is Apple. And in the short term, they're airlifting iPhone handsets from India into the United States. In the long term, the White House sees a world in which the iPhone is assembled in the United States. Do you see that future being achievable for this White House?
Not really. That's sort of the fundamental flaw of the hawkish trade outlook, is there's a notion that you can have a trade balance with all countries, which is ridiculous in the sense that, low-income countries have low labor. They're going to be exporters. That's one way they grow. And then the second thing is, if you run a gigantic budget deficit, you have to have a trade deficit. Financial flows need to equal physical flows. So the first thing you need to do if you want to have zero trade deficit is lower your budget deficit. So that objective is ridiculous. Yeah. It might have led to the bag of bricks comment from Musk, not me. And so that's why it's disconcerting to be in this market, because one side is arguably nutty and the other side is more pro-business, and we don't know who's going to win.
Jay, at the moment, it looks as though the House is going to adopt a plan to advance Trump's tax cuts and also the debt ceiling hike. I want to get your take on how we can align what many had thought would be a tax policy that offsets some of the volatility of tariffs. If the House can push forward and agree $1.5 trillion in cuts for the budget, is that the right policy right now?
Absolutely. So that offsets if we end up with sort of 2% of GDP, that's about a $600 billion tax increase. So we need to offset that. And in fact, that's what the flaw of the initial strategy was, is that it just came too fast. You could have just said, well, in a year we'll do this, and then you had plenty of time. And so they came way before the tax cut. And that's what's destabilized the market. And it's just an own goal if you play soccer, because they didn't need to do that. It was just coming out of this. Yeah, oh, good. Yeah, good. I tried that with one of your reporters, and they looked at me like, what does that mean? I'm not the biggest soccer fan either, but I know what that is. So That's the issue, is that timing was horrible. They could have gotten the exact same place by just saying they're going to do this without doing it right away, waiting for the tax cut, waiting for the Fed to figure out inflation's coming down. So it was just at the absolute wrong moment. Also, it wasn't earnings season. We think earnings season will calm people down, maybe not get the market to skyrocket, but when you hear from companies, their stocks tend to rally, because then you get certainty, even if it's not great, like Delta's guidance was highly, was bad actually, and stock, this is before the announcement, skyrocketed. So we think any news, or most news, will be viewed positively, and that earnings season will stabilize it. So all this tariff news came into absolute terrible time during a normally weak March. So now, not that we're super bulled up about the market, but we think it'll stabilize kind of in this 5,000 to 6,000 range. It's not very stable, 5,000 to 6,000, but be banging around in that range. So we're neutral, not negative. We were negative before this policy change.
Jay Hatfield of Infrastructure Capital Management, who I think was quoting Howard Marks on the own goal analogy. Thank you very much. Now, coming up, tariff threats actually helped fuel TSMC's AI-related growth surge at the start of the year. We'll have more next. This is Bloomberg Technology.
Quick check on the US listed shares of TSMC, their ADRs. Look, they're going to be following the broader market lower at the moment, off by 4.8% after they rallied hard yesterday. But we've got to keep in mind that the company actually posted sales growth, 42%, on, of course, AI demand ahead of US tariffs. For more, let's bring in Peter Elstrom. And what's interesting is the inventory buildup is so plain to see. This is the chip provider for Apple, for NVIDIA.
Right. We don't have all the numbers from TSMC yet. All we've gotten is the revenue for this quarter. As you say, though, it's a 42% growth rate. It's very, very strong. They bumped up revenue to $25.5 billion. So you've got a $100 billion run rate company that's growing at 42%. It's pretty extraordinary. What we don't know, what we'll find out next week as they report more broadly their earnings, we'll get more detail on that. We'll figure out how much of this is inventory. As you say, there's probably some stockpiling going on right here. Two of their biggest customers are Apple and NVIDIA in particular. They may be accelerating some of their purchases to get ahead of some of these tariffs so that their customers don't have to pay high tariffs as they get into the next few days.
You know, the data is highly analogous with what we saw from PC shipments, right? Front-running tariffs they knew were coming. That's short-term. Long-term, TSMC has pledged billions of dollars to build chips in this country. Have we learned anything more about that in its progress?
Well, they didn't say anything at this point, but you're right. They had previously pledged to invest $65 billion. More recently, they said they're going to add another $100 billion onto that in U.S. investments. They clearly want to make chips in the U.S., partly to diversify themselves geopolitically. Partly they'll be able to serve these customers like Apple, like NVIDIA, like Tesla more effectively if they're able to do it in the U.S. And they'll avoid some of those tariffs if they're going to get hit with those. Now, TSMC doesn't sell that many chips directly into the U.S., but via Apple and via NVIDIA, some of their other customers, they could get hit by tariffs that go through their end products.
Bloomberg's Peter Hellstrom, thank you very much. Right, next on the show, more on Apple, really important conversation. Stay with us. This is Bloomberg Technology.
Quick look at shares of Apple falling after yesterday's massive rally. But there's also reports that it shipped about 1.5 million iPhones from India to the United States in an effort to beat President Trump's tariffs. According to Reuters, Ed, it's fascinating that 600 tons worth from India. Who knows what they were shipping on jumbo jets from China?
Right, I did the math. I checked the math. 600 tons, the average weight of an iPhone around 7 ounces. So with packaging, I think 1.5 million makes sense. That's short term. Long term, the only question is, can they build the iPhone outside of China and where? Here, the United States? Who knows? Let's get more on the fallout of US-China tariffs and its impact on Apple. Carolina Milanesi, president and principal analyst at Creative Strategies, joins us. I mean, in a world where the iPhone's built in America, there are many estimates. Bank of America this week said it would be 90% more expensive. That is an interesting scenario, Carolina.
Is a very interesting scenario and one that I don't think is going to happen anytime soon. I think that Apple has other options before coming to the US, and that's because unless we are moving part, at least, of the supply chain to the US, it's really unreasonable to think that Apple can be successfully building iPhones here. So what you're seeing with the shipment coming from India is that Apple has the opportunity not just to ship, but to actually rethink how and where they build iPhones that are targeting the U.S. market. So they could shift from China to India or other manufacturing facilities to avoid some of the harsher tariffs that China is faced with today. obviously, all of this can change tomorrow or this afternoon.
What about, of course it can, but the margin pressure? How much will they suck up some of the margin pressure? How much do you think they can pass on to a pretty stressed consumer here in the US right now?
There's two aspects of it. One is to remember how strong Apple's relationship with their supplier manufacturer is. And so there might be a negotiating part there where it's not about just Apple passing on to the consumer, but is Apple trading with their supply chain to see how best everybody can ride this wave, right? At the end of the day, you want to keep the Apple business with you for the longer time. And then when it comes to consumer, I think it's a very critical moment for Apple here in the US market when it comes to services and Apple Intelligence in particular. So they will want the upgrade cycle to continue. And they might decide that it's worth sacrificing some of their margins in the short term to then have more revenue coming from services and Apple Intelligence longer term.
A story's hit the terminal just now clarifying that the Trump tariffs on China now add up to 145%. You see Apple declines accelerating 5%, NASDAQ 100 pushing even lower. An airlift, though, have you ever seen that in your career? We just have 30 seconds, Carolina.
I have not. It's definitely something new, and I think it comes with the volatility that we're in right now.
Carolina Milanese, there with all the expertise and the context, President and Principal Analyst at Creative Strategies. Thanks so much for joining us from Vegas. Meanwhile, coming up, more on the market reaction as we see losses accelerate. The NASDAQ is currently off by more than 4%. Nancy Tengler, the voice we go to, CEO of Laffer Tengler Investments, where she's adding. This is Bloomberg Technology.